Welcome, Coleman's 2015 SBA 7A Certified Liquidation Training. This is it, week 7. We only have one more week left, Lance.
It's hard to believe, Bob. Just one more fun week for them, and they've worked through probably some of the more important material. They're all PDK or Purchase Demand Kit specialists now, Bob.
All right, very good. If you have any late questions, shoot them over there to Joseph. Let's go to the poll questions. Have you ever forgotten to wrap up and charge off an SBA loan? I guess that's at the very end, correct?
One of the things, Bob, that SBA is, especially on these new Paris reviews, one of the things that they're looking at is how well you finish on your SBA loan. And doing the Purchase Demand Kit, you're not done once SBA pays you. You still have to wrap the loan up and make a recommendation for charge-off. Now, granted, everybody's probably forgotten one somewhere along the way if they've been involved in SBA lending, but it's very important for you to get those loans wrapped up. And when you look at the Paris review, which is going to be, the format for lender reviews going forward, one of the categories that they measure you on is how many of your liquidation cases take more than 3 years. Well, those where you didn't wrap them up are going to count. So,
1/4 have forgotten. 3/4 are righteous.
And Bob, I just want to tell them it's perfectly okay to have forgotten one. Pick it up and wrap it up now. Get it finished, get it off the books, and you'll be fine.
Have you ever received a recovery on an SBA loan after it was referred to Treasury?
And Bob, this question is just, I guess, out of really incredible curiosity. When I was deputy at SBA, and I know you're aware of this, Bob, it was about 6 years ago that SBA got dinged by the Inspector General for not referring loans to Treasury. And it's been a real point of emphasis for them once the loan is wrapped up. If there's no compelling reason like a bankruptcy discharge, they refer them to Treasury. And sometimes, like if your borrower goes out to Las Vegas and gets lucky on a roulette wheel, guess what? You might get a recovery. So I was just curious if anybody had ever gotten one.
60% have.
Really?
Wow.
Fantastic.
Yeah. Now, how's that work? Does the bank, I don't know this, does the bank get a check and they have to remit the portion to SBA, or are they, it's just their pro rata
No,
share?
in this particular case, Treasury's going to recover and SBA will get their portion, and then the bank will get a check for the unguaranteed portion.
Interesting, very good.
Because by this time, SBA has paid on the guarantee. So you're not going to get that portion. So if 75% guarantee, you'll get 25% of the recovery.
How many times during the liquidation of an SBA loan have you abandoned collateral? Never, a couple times, more than 3.
Bob, I love asking this question because I am dealing, as you know, a lot of my poll questions tend to focus around things that I'm dealing with as we speak. And I'm dealing with a convenience store loan right now where our phase 1 and phase 2 have indicated the need for some environmental remediation. And we're evaluating whether or not we want to abandon this piece of collateral.
Let's see, 50% have never done that, 25% a couple times, and more than 3, 25%.
Okay, good.
And before wrapping up an SBA loan, which of the following do you do in regards to the guarantors? Run the credit report, review it, run an asset search on the guarantors, review the most current financials and tax returns of the GOO. What's the GOO?
Something happened to that one, Bob.
I assume that's the guarantors.
Well, and I asked this question because one of the things that participant banks forget to do between the payment of the guarantee by SBA and wrapping up the loan is taking a close look at those remaining guarantors and seeing if there are any assets or any potential for recovery. Now, majority of the time the answer is no, but you at least want to run a credit report. If there's any financials, and when I say review the most current financials and tax returns, you're probably not going to get updated, but take a look at the most current ones and compare those to the credit report or the asset search. And if there's something going after you, need to do it.
How are you doing the asset search? What?
There are companies that will run an asset search, and quite frankly, if you've got a good current credit report and you've got financial statements that are not 10 years old, say you've got one that's a year old, I would rely on that. But in some circumstances, Bob, I picked up files where there was no financial statements since the time of origination, and in that particular case would run the asset search just to take a look at what they potentially have.
Very good. What's the recap? What's the takeaway from week 7?
Well, I think week 7 we finished up, or we talked about charging off the SBA loan, what a wrap-up report looks like, and Treasury referrals. Now, again, we talked about this in the poll questions, but you're not finished with your SBA loan until you wrap it up and make a recommendation for charge-off. And one pesky thing that SBA will do that I just want to caution everybody not to get too excited, because I dealt with one this week that a bank, I may have mentioned, Bob, it was one that was 8 years old that I was wrapping up for a bank, and they continued to get requests for the quarterly report, the quarterly liquidation report that SBA asked for, and they were upset about that. But quite frankly, we submitted the wrap-up report about 4 weeks ago, and it's going to take SBA probably 2 or 3 months to get that processed. So after submitting the wrap-up report, your request for quarterly reports will come. Just mark it, ready for charge-off, and over in the comment box put wrap-up report was sent on this date. And just keep a copy of it and continue to send it.
We have a question. I have 2 loans that went into liquidation status, and I sent a request to the SBA to purchase them from the secondary market, which they did. I received 2 checks from the SBA with no explanation except for SVC fee 1%, the dates, and what is this, and how do I apply it?
Well,
I'm sorry. Then there's further. I have done the math. It appears that is 1% of the guaranteed portion balance divided by da 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 da. Go ahead.
What's really nice, Bob, is I love questions where they answer the question for themselves on the final comment. On a loan that's sold in the secondary market, as we all know, when you put it in liquidation, the investor's portion has to be purchased, either by the bank or the SBA. In a majority of circumstances, probably 98.9, or it's real high, Bob, I don't know, the SBA ends up being who buys the loan back from the investor. At that point, you could get a bill for underpaying what's owed. And here's something I want to bring up that has happened recently on a loan. It was a legacy loan that I was working on with a bank, and I got it, and it needed to be put in liquidation. The loan had been in default for a significant period of time. They did not put the loan in liquidation until 9 months after they should have, and they had not collect payments. Well, SBA billed them for that period of time between the loan going into default. Had they put it in liquidation at the right time, the loan had been purchased at the correct time, there would have been no bill. But in this particular circumstance on the question, it's obvious to me that on the 1502 report, you're supposed to reduce the interest that you send in by the amount of the servicing fee, and it's obvious that that was not done for a period of time. And I got to be honest with you, whoever this banker is, and we don't have a name or a bank name, but you should be overjoyed, because probably 80% of the time, Bob, when it's bought back from the secondary market, you get a small bill. In this case, you got some money, so smile. Now that's, you asked, what do you do with it? It's fee income. Wherever you would put, for instance, if you sell it on the secondary market, the premium you get, or wherever you book your servicing fee income, that's what it is. It's just servicing fee income.
Or would it be an offset to servicing fee expense? It's probably immaterial. It's probably immaterial.
Yeah, in this case, I think it would be booked as servicing fee income, but it could be an offset.
I would tend to go the other way, but it's probably immaterial from that standpoint.
Hey, one thing, Bob, I want to bring up that I've struggled with a few bankers, and it's just a comment because we talked about the purchase demand kit for a couple weeks prior to this, and this really is in conjunction with this. When you get paid on the guarantee, a mistake that banks frequently make is they want to apply the SBA guarantee payment to the balance of the loan. You don't do that. And you'll want to talk to your accounting people to make sure you're booking that properly, but it really makes it difficult. For instance, we're talking about wrap-up and charge-off. If you apply it, it's going to cause getting your wrap-up and charge-off recommendation through SBA to be impossible because they're still going to want to see the final transcript. And that guarantee payment should not reduce the principal balance of the loan on the transcript. Your accountant should understand, but there's a different way to book it. But when you get paid by the SBA, don't reduce the borrower's balance by that amount.
Good, great. What's on tap for week 8?
Week 8, we talked about some special liquidation issues. We're going to identify those liquidation actions that have to be approved by SBA. We will talk about some of the required documentation requirements during the liquidation process. We are going to touch base with improper payments because I think it's important for our participants to understand improper payment. You can get paid on the guarantee by SBA, and they will review a cross-section of those guarantee payments, and it's possible you could get a bill back from the SBA if it's deemed that it was an improper payment. So you need to understand that process and some information about that. And I just shared some general SBA lending information and statistical information during the week. So it's a bunch of different, what I consider special liquidation topics, Bob.
Lance, do we have an idea of how far SBA goes back? I know at one point in time there was an informal 24-month. If you hadn't heard from them in 24 months, you were safe. Well, we've read some Inspector General reports where they've gone back 4 or 5 years. Do you have any inside information about how far back they go?
Well, it's difficult. Typically, the expectation would be 2 years. But in my time at SBA, Bob, I also had the opportunity to witness many examples of loans, guarantee payments 3, 4, 5 years in the past that were indicated for an improper payment. So there's nothing in the SOP or in a CFR that tells exactly how far back they're going to go. That is the reason, Bob, that liquidation, and guys, liquidation is so very important, and putting your purchase demand kit together properly is so incredibly important, and accounting for guarantee payments and recoveries is so important because it's not just on the SBA to make sure that you're being paid properly, but it's on you as a prudent lender to make sure you're being paid properly. And I mean, I won't have an on-the-record conversation on how to deal with improper payments, but if any of our participants would like to have a private email, I can share with you my tact on when SBA comes back and says you owe us something.
That seems to be code for something. I know exactly what the code is also. So
it's not really code, Bob, but I would hate for my strategy that I use to be clipped out of a video and sent to the SBA because I think it would kill me on future efforts.
There you go. Very good. Do we have any more questions? No. Very good. Enjoy last week. We'll catch you next Friday for office hours. Enjoy the weekend. Thank you all.
Guys, look forward to seeing you next week.